Welcome to another episode of Ask the Expert on the Contingent Workforce Strategies LinkedIn group. I'm Jeff Nugent, and I'm super excited about our episode today. It's a very, very important topic, but even I'm more excited because I've got a really special person for you today. Someone you may not know, but I've known for many, many years. He's one of my best friends. Not only in the industry, but in life. He was one of my college roommates, a business partner of mine, and is currently the president and the COO of People 2.0, Steve Schaus. So welcome, Steve. So excited to have you on and talk on the topic of finance and cash flow best practices in the contingent workforce space and the staffing industry. And there's no one better in my mind than Steve on this topic. And this is why we're business partners and why he's running People 2.0 and his experiences within the staffing industry and working on large contingent workforce programs, pricing it out is second to none. So welcome, Steve. Thanks for coming on the show.
Thanks, Jeff, although I think you set the bar a little bit too high for me there, but I appreciate it anyway, so thank you.
Hey, I always, in the industry, people have Nugent stories, and given our history, I think you have probably some of the best ones, but I'll leave that for another episode.
Keep those to ourselves for now.
Exactly. So, this is a topic that often doesn't get a lot of press. It's not sexy, but it is so essential to the staffing business and so essential when it comes to contingent workforce management industry. Cash flow, and finances, because, often, finding people and compliance gets a lot of press. It's very sexy. But the lifeblood of our industry is cash flow and finances. So, it's become a really interesting topic of late because of interest rates over the 2023. Interest rates climbed ridiculously levels, and it really shifted, the cost of money and how people deal with cash flow in our industry. So, can you talk a little bit about how interest rates and inflation costs are affecting our industry and how it affects, overall the contingent workforce management space?
Yeah, absolutely. I can do that. And just a little bit of background here. I mean, I think Jeff recognized this a number of years ago. Jeff mentioned that we were business partners, and he actually brought me into Contingent Workforce Solutions that he had started. And Jeff recognized that within a staffing or an employer of record business, there's a couple different businesses within that business. And if I look at a staffing firm, up front, you've got what most people think of as staffing firm doing, and it's the recruiting and sourcing, and they're very good at that. And then the natural follow-on that most people think about to that is kind of HR compliance and HR services and all things around human resources. But the pieces that many people don't necessarily think about is you're also in the lending business and you're in the insurance business. And that's why Jeff and I were a great fit. My background, I'm an accountant and was in the restructuring business. And you need to get all those pieces right, because the service you sell is a recruiting and HR service. If you're in the staffing business, you're selling both. If you're in the EOR business like we are, you're really selling an HR service. But where you can really kind of make or break your business is if you get the lending or the insurance part wrong. And I think people have gotten very complacent over the last, frankly, probably since you go back to 2009, after the financial crisis in 2008, that the kind of interest rates went practically to zero. And they did that all around the world. If I look at interest rate graphs for Canada and the US, if you take from kind of beginning of 2009 right through really to beginning of last year, beginning of 2023, interest rates hovered, 4%. And people got very complacent because money was cheap. And so people went out bidding or pricing their services, having a very narrow, if anything, price of interest, or the price of the lending part of your service built in. Interest rates have tripled since then. I think in Canada, prime rates are 7.2-ish%. They're over 8% in the US, which effectively means the cost of carrying a receivable for your client, that price is more than doubled. If you add a little bit of spread on interest in Canada, your cost of carrying 30-day receivables is probably gone from about 0.4% to 0.8, maybe even higher. And that's real money in a business that's under a lot of just general pricing pressure. So
Well,
I think
take a step back on it. When you think about the volume of cash that is
correct,
involved, because you're paying people's wages, right?
correct.
And when you
Yeah,
talk about accounts receivable, what ends up happening is you're paying the people
yeah,
first on a
yeah,
Friday, and then
that's right.
depending on the terms, the client, you're invoicing for their services. And then depending on the terms, you're waiting to get paid. And that there's a cost of
Exactly.
that
Yeah,
lending, right?
yeah, yeah. And yeah, staffing EOR, it's effectively kind of a pass-through business. A significant part of your invoice is just the flow through of all these direct costs that you owe on a pre-specified time horizon or timeline to workers and to clients. And an important part of that, like cash flow and liquidity management 101, if you're an accountant like me, is when cash gets expensive and liquidity gets tight, you manage that by delaying payments to your suppliers. But when you're in the staffing or EOR business, your suppliers are people, and the cost of those people is salaries.
Yeah.
And you don't have the ability to delay that. So you're getting squeezed on both ends. You're continuing to pay those salaries up front. And you've got your suppliers who think they can, or your customers who think they can just delay payments to you. But that doesn't work, because to your point, Jeff, 80% or more, depending on where you are in the kind of margin spectrum, can be just costs that you're passing through and you have to pay, because you got a B2B relationship with your clients, and you have an employment relationship with your suppliers, which adds an extra element to this, right?
Yeah, and you can't miss payroll, right? In
Correct.
staffing industry, it's an employment model, and there's
Yeah,
legislation and regulations that you need to pay. And quite honestly, if you miss payroll, you're dead in the water reputationally as well, right? So
that's right.
that's where the squeeze comes in, is
Yeah,
you have a finite time that you have to pay, and then this loosey-goosey sometimes, you know, time frame when you get paid back. And so
correct. Yeah,
it's cash flow
yeah,
management. And so talk to me about some of the key components and dumb it down, like, because
sure.
there's a 101
That's
when it
easy for
comes.
me to do.
Yeah, I know it's innate for you, Steve, but dumb it
Yeah,
down a little bit. Like, what are some of the key components of cash flow? And
yeah,
then some of the, thoughts on best practices around managing the cash flow, and how is cash flow happen, right? Because
yeah,
either the company has retained earnings, which has a definition to it, money in the bank, let's call it, or you're borrowing it, and there's a cost of borrowing it too. So let's talk about what are the key components of cash flow, what goes into it, and what are some ideas around best practices in managing cash flow.
yeah, sure. Yeah, the key components again in this business is a significant amount of the outflow is payroll going out to workers. And depending on whether you're in North America or in Europe, in North America, that tends to happen every week. You run a payroll every week. Europe, it's more monthly, but so you've got that major outflow that you have to get right every week. That's 50% plus probably of your cash flow going out the door right there. You have all the government remittances and insurances and everything else that go along with that, sometimes on a little bit longer cycle, depending on which jurisdiction you're in and which remittances we're talking about. So that gives you a little bit of time to play with. And then finally, you have all your internal costs. And again, in this business, internal costs in the EOR and staffing business, people are a significant portion of those internal costs. So you're again back to back to payroll being a significant part. And you really have zero flexibility on timing of any of those payments. It's money that has to go out the door every week. The only way you can get covered on that is financing those receivables, as you said. You can go to a bank, get a line of credit. They'll give you credit for a certain portion of those receivables, and that's what gives you that timing mechanism between a 30-day receivable from your client and a every week payroll run that you have to send out to your suppliers who are employees. But there's a cost to that, and that cost is prime plus some sort of spread, and that cost has more than doubled on you in the last 24 months.
So one of the components, and I've seen some posts on LinkedIn where there's been scams in the EOR business, and a lot of the times it's been some of the platforms, but every employer of record or every staffing agency has what I would call bad debt, right? And bad debt happens when you don't get paid for some reason or other, and you've ended up having to pay for the services of the worker through that payroll, and you don't receive the money back from the client.
Sure.
For whatever reason. And some of these scams that have happened are fraudulent companies being set up, fraudulent people being set up, payroll being paid out. And then, of course, if it's a fraudulent company, there was never any real expectation of ever paying back the supplier, right?
Sure.
And that comes to mind due diligence, right? Due diligence and credit analysis. Why is it so important to do that as part of your cash flow management as well? And is there some mechanisms around credit analysis, how to do it, providers that can do it for you, ideas around, ensuring that you're not going to have those situations where you're not getting paid on those receivables? Because if you're paying out, let's say your margins are, let's say 20% or 10%, and in the EOR game is 3% sometimes, right? Paying out 97% and then them not paying you back on that, it can sink your ship. So what are some ideas? Why is it so important? And I kind of answered that question there, but it's what are some best practices in credit analysis and ensuring you get paid?
Yeah, I mean, I would say the first line of defense is just know the people you're dealing with, right? So it's easy to get into a very transactional mode where you've got something coming in through technology and it looks legit and you're just moving quickly. And I mean, the world is changing very rapidly and we're all busy, so it's easy to do that. But the best line of defense is try to have a relationship with your customers and try to have a relationship with the workers you're employing on behalf of those customers. Pick up the phone and find out if a real person answers and there's somebody legit and get to know them. After that, there's really all the kind of, I would say, what I hope to be fairly standard onboarding practices, both for a client and an employee or a contractor in our industry. Make sure there's legitimate tax ID numbers. Make sure there's check with all the relevant you can do checks with relevant agencies, et cetera, that they're properly filed and properly established companies. They have a proper kind of domestic bank account, all that sort of stuff. Where you can get some outside help, well, back to the front line of defense, some referrals if you think that's necessary. If there's any yellow flags at all, then really question it, right? Make sure it passes the smell test, and if not, ask for some referrals to do a backup check. And then on the kind of more outside help from a credit agency side, check DNB, check Dun & Bradstreet, check the credit kind of reports. Not all companies, if they're a startup, may have that, but check. And then you can also get receivable insurance if it's an established company. Euler and Coface, and they'll do their own credit checks, so you can outsource some of that. But there's an expense to that too, so it still comes back to pricing. And finally, I would say again back to the smell test. If anything doesn't seem right, then I would request an upfront deposit. Make sure you get 1 or 2 months of payroll. Just quickly, the last thing to keep in mind, again, what's a little bit different in this industry than many others, if you're into a deal or a program with a client, and things can change, and what used to look like a creditworthy client no longer becomes creditworthy, you got to be mindful of the cost of exiting that relationship. And again, that stems from the employment relationship you have with the workers you're managing. It's not just a matter of calling them up and saying, we're not paying you anymore, and stop reporting to work. There's a process you have to follow, and there's an expense that you're still going to bear, even if the client's not there to pay for it. So a lot in there, but I think the biggest thing is the smell test and get to know people. So
Yeah, I know in the past, the receivables insurance, they were very good in doing the credit analysis in a lot of cases. And like you mentioned, I knew a few examples where we had clients that
yeah,
weren't doing as well in tough times in the retail industry specifically.
yeah,
And we had a large number of workers there and a large payroll out and a large receivable with, and they started ratcheting back on the allowable amounts that they
yeah,
would. And they started to say, listen, we won't insure these receivables because we see them moving towards
that's
bankruptcy.
right.
And so
That's right.
that then allowed us to have conversations to work with them. And quite honestly, we ended up transitioning to what you just said, a paid when paid scenario where they actually paid some payroll up front in order to
Yeah,
have us to have the cash flow without the credit risk. So,
yeah,
credit analysis is not sexy, but it's essential as well to maintaining that cash flow and making sure you're getting paid on the back end. Because there's
absolutely.
nothing more annoying than receivables calls, right?
Yes.
Clients
Yeah,
are
yeah.
always like, oh, your receivables department are annoying me asking for payment. But you also have to understand that the suppliers just paid out millions of dollars to your workers, and they want to
Right.
ensure that they're getting paid back. And so
That's it.
be more empathetic when you get those receivables calls. And maybe they should probably have nicer people on the receivables calls, but
That's it.
but it's a balance. So thinking
Yeah.
about that is important.
And I would say clients don't always appreciate that kind of employment relationship behind a staffing firm or an EOR. And I think if you talk to the right people on the client side and remind them of that, usually they're pretty sympathetic to that. But they don't know, they don't always remember that or appreciate that. So
Yeah, no, it's hard because cash flow is the lifeblood of the staffing industry, and you're paying their people for them, right?
that's it.
And by having these terms, you've just asked your supplier to be your bank. And often the
Exactly.
program people and things like that don't realize that that's what you're asking them to do. And they don't see them
Yep.
as, you don't see your supplier as a bank. And if you did, maybe you'd be nicer to them, because generally when the bank calls you and is going to talk
That's
about your
right.
mortgage payments,
Yeah.
you pick it up, right? So it's an interesting dynamic, and it's something to really highlight. One thing I wanted to talk about as well, because there's the bigger talk on, cash flow,
Mhm.
interest rate increases, cost of money is more expensive. When it comes to financing and finances within the staffing industry, of course, then once you have your understanding of all of those components of the cost of money, it then leads into pricing. And so
Mhm.
pricing is an interesting beast because clients are always wanting the lowest price. You've
Mhm.
got governments always changing and ratcheting up, for the most part. Sometimes government remittances go down, but for the most
Yeah.
part, they have an upward trend in a lot of cases. So there's those kind of variables that then the staffing providers in a very highly competitive market are now having to price things out and are really being kind of pulled in various directions. So talk to me about, component costs, and I mentioned a few of them, of
Sure.
pricing a deal. and cash flow is part of that, but there's always the cash, the cost of the service itself and having to provide that. And then there's the government, of course, etc. So talk about some of the component costs and how, pricing is not as easy as just give me your all in. What's your all in? Is it 55% markup? There's a lot of
Sure.
components that go into that clients should understand and start to really look at. And can you talk to more of those components and how they vary?
Yeah, absolutely. I mean, when you're looking at determining a markup on payroll, um, there's a lot of factors that go into that. The first one is really all the pass-through costs we talked about. And even that is not nearly as straightforward as maybe some people think it is, because there's a number of payroll taxes, as I'm sure everybody kind of listening to this knows, that cap out when certain limits are hit. And those caps are very different by state. They can fluctuate significantly depending on the term of a contract. Is the worker with you long enough to hit those caps, or are they not? And then after the cap is hit, how much longer do they continue to get paid? Because your pass-through costs will drop for that component. And what's the pay rate of the workers, et cetera. So there's a whole lot of factors that go in to determine even what that true pass-through component is.
Yeah.
And there's always a game, not a game, it's not the right way to describe it, but a trade-off
Yeah.
between getting kind of fixed or locked in pricing, where you're asking the staffing, from a client's perspective, if you're asking that staffing firm or the OR to just say, I just want an X% markup, well, they're going to have to take some fairly conservative assumptions around when those caps hit, et cetera. So you're not necessarily going to get the best price if you want it locked in. And that's from a EOR's perspective, that's just us protecting ourselves from, call it the workforce population and what that looks like. Then there's the cost of providing kind of that HR, and in a staffing firm's case, the recruiting services that layer on top. So really kind of having a shared understanding between client and provider on what the scope of those services are, who's going to do what becomes important, and that needs to get added on to figure out the right markup. And then kind of back to the beginning of the conversation, there's pricing for the lending and pricing to some respect for the insurance, right? So do you really want your EOR staffing firm to be your bank, and do you want 90 or 120-day terms? Well, the industry did get complacent on how that got priced. The industry needs to get a lot more kind of scientific and think more like a banker in pricing that, because there's real costs to that now. So that needs to layer on, and that can be a relatively simple calculation, but both sides need to be aware that one way or another, that's a real cost that needs to be absorbed somewhere. And then finally, on the insurance side, there's all the employment insurances and all the things that tend to flow through some sort of recognized kind of body, or there's premiums for that. But there's also the cost, building in the cost of any indemnities or other employment related risks, any exit costs of exiting the employee, indemnities. In some cases, customers want indemnities for the work product, even though the supplier may not be really managing their day to day. So that needs to be at least considered and built in, because that
Yeah, and those are
there can be a real cost
they're
to that
not
too.
tangible, right? Those
That's right.
when you're trying to price out risk, it's intangible numbers that you're making a lot of assumptions on.
Exactly. Exactly.
And then you try to amortize it over the size of the deal, and you go,
Yeah.
okay, let's put this percentage in for that risk, but because the deal is bigger, we can ratchet that down a little bit. And it's really a lot of levers in the pricing when you're and with intangibles, like you're saying. It's amazing.
Yeah. Yes. And I think the key to all this is probably transparency in both directions. Transparency from the client, giving enough information to the supplier to price those things in a reasonable way, and transparency back in the other direction, to show how each of those components was built into the price. And that way there can be an honest conversation and think like partners in what should the client bear, what should the supplier bear, and what's the price of each of those components. Ultimately, you get what you pay for, right?
Yeah.
So if you're trying to jam the supplier down and accept all sorts of unreasonable indemnities, take 120-day payment terms, the scope of work is we negotiated this, but now it's become this. Ultimately, that's not going to be a successful relationship, and it's gonna deteriorate the experience for the contractors, the employees, the workers, which is not where either side wants to be. I mean, that's a valuable resource, and you need to see that service as something that kind of reflects on the client's brand as well. So if there's transparency in both ways, you can get to the right answer, right?
Yeah, and it's interesting because kind of from the get-go, I mentioned it's a highly competitive industry, generally low barriers to entry. So
Yeah,
you can become a staffing agency tomorrow unless there's certain licensing regimes in different jurisdictions, but it is a
yeah,
fairly low barrier, so they can jump into this business quickly.
yeah,
And unfortunately, when you are a big organization or a big client, you sometimes have set up a procurement mechanism that's solely looking at getting the lowest price, the
yeah,
best service, the
yeah.
longest payment terms, and that's seen internally as success, right?
Yes, yes,
With balancing, of course, quality and some of those things too.
yeah,
But when you try to outsource too much risk, you want your supplier to be the bank. You want to then, want everything all rolled up into one, but then you want the lowest price. It becomes
yeah,
a difficult situation. So,
yeah,
that, like you say, the transparency is so important to build a good relationship. And it's not always, you know, well, you sign this because you've got 100 people standing behind you that will. I've 100% said no to certain clients in those circumstances, and you've helped me say no. Actually, that's
mhm,
the other
yeah,
side of it over the years, um,
yeah,
where you want the deal to happen, but you need to say no because, quite honestly, the person behind doesn't know what they're signing up for,
sure,
and it will over time, like you say,
yes,
deteriorate into a bad situation for the workers, for the customer, for that supplier too. So, knowing this, being very transparent and working
yeah,
together with your chosen suppliers to be a mutually beneficial scenario is the best for all.
exactly. Yep, totally agree. Totally agree. As they say, cheap, fast, and good. You can have two, you can't have all three. And if you expect all three, eventually you're going to be disappointed, right?
Yeah. Well, on that note, Steve, I know we could talk more and more on this topic, and it's something that's near and dear to your heart, but also mine, given the businesses we've been in together. So,
Yep,
but this has been an amazing conversation, and I want to thank you for your time, and
my pleasure.
look forward
Anytime
to.
for the Nuge.
Yeah, you got it.
Okay,
Take
thanks,
care.
Jeff.
Talk soon.
Thanks, everyone.